Tariq, welcome back. Well, there are lots of questions, but to cut or not to cut, that is indeed the major question. But from the recent minutes that we saw, it doesn't seem like there's a clear consensus within the US Central Bank, because some they were saying that there needs to be some flexibility. A couple of them were favoring a 50 basis point cut, and some of them they're even saying there are no cuts needed. So how do you interpret this variation of views in the minutes, the intricacy of the minutes?
Well, I think how you interpret it depends on which part of it you're looking at. If you purely look at the yield curve is already telling the Fed to cut, that the whole curve can be under the Fed funds rate. And then that leads to the question not if to cut or not to cut, but to cut 25 or to cut 50. Now, the good news about a 25 basis point cut is that it's measured and it indicates that the Fed is trying to adjust and make sure that the yield curve is more or less in place and that rates aren't too high to choke off anything. Now, the case not to cut is that the US economy is still fairly healthy when you look at employment numbers and you look at overall consumer spending numbers. The other measure which I've often pointed to when I've said that interest rates aren't likely to rise very high is that the US economy, many of the largest companies no longer depend on debt as much as they used to. If you think of, say, Google or Amazon, raising or cutting rates by 25 basis points won't affect them as much as, say, General Motors, which relies a lot more on capital spending and interest rates.
And in your view, in terms of the 25 basis point cut, was it nothing more than just a mid-cycle adjustment from the Fed?
If you would want to call it that, I might still call it a late cycle adjustment. And it is an adjustment when it's still a low measured pace, really to just keep up with the yield curve. Usually what we've seen in both 2008 and 2001 was when the economy was plummeting into recession, that's when the Fed did 50 basis point cuts. That is reactionary, whereas the 25 basis point cut is still the Fed trying to be a little bit ahead of the curve, but not too far ahead of the curve.
Right, and then what do you anticipate the path of the rate policy from the Fed would be in the near term? Do you anticipate a cut still, or it's been clouded by some uncertainties at the moment?
Well, there's always uncertainty, but I think the yield curve is telling you a cut is more or less baked in. The polls that I'm now seeing on Twitter is the next stop going to be 1% and 0.5%? Is the U.S. going to enter negative interest rate territory, or is it going to return to kind of a normalization of 3%? I think there's more pressure keeping rates down, keeping the 10-year under 2% and 2.5%, than there would be, say, pushing it all the way down to zero. The U.S. still has fundamental strength that the Eurozone and Japan do not have. Those are the economies that have entered negative rate territory, and the U.S. does not want to enter that territory. If anything, the Fed should cut rates, if anything, to allow a little bit of inflation and ensure it doesn't get into that negative rate spiral trap.
And since we were mentioning a bit of the yield curve, obviously there were talks about the yield curve. Some Fed officials, they have expressed concerns about the inversion of the yield curve. So in your view, does the inversion really pointing at, the US economy is heading towards a recession, or does it mean anything else? Are you concerned?
Well, historically it has. In the past 6 recessions were all preceded by yield curve inversions, and the past 6 yield curve inversions were all followed by recessions. So that particular indicator has a really, really good track record. Now, that doesn't necessarily mean it's going to work again this time. You should also look at why is it that long-term interest rates are as low as they are. Don't forget that the U.S., in addition to having a strong economy, also has an aging population, like a lot of other countries. Old people buy lots and lots of bonds, and they have lots of fixed income needs that they're trying to meet with those bonds. Some of them may be rushing to get in that 1.5% to 2% before they may fear it goes to 1%. That's the Japan path I think a lot of us fear. I don't think that that's going to happen, and I'm not as worried, partly because I believe the U.S. still has some fundamental strength that the Eurozone and Japan do not have.
So you spoke of the strength in terms of the U.S. Fundamentals in the economy. So which side do you think is stronger at the moment, the consumer side or the business side, and how resilient are they going to stand in the face of all these global geopolitical uncertainties?
Well, you can't separate the two. American business is only strong because the American consumer is strong, and the American consumer is strong only because their paychecks are strong. The two are, you cannot really separate them. Now, someone recently said that the only 2 engines of growth in the world right now are China and the U.S. consumer. Now, the flip side is you're talking about the Chinese producer and the U.S. consumer. That's the whole reason we're having a trade war right now, is because China loves to produce and save. The U.S. loves to borrow and spend. So the reason we're having a trade war is that politically, we want some adjustments to that. Although overall, as long as Americans have paychecks, as long as they keep their debt in check, they don't borrow too much, and as long as they keep producing and increasing productivity, the American economy will continue to hum along. The other important thing, as I mentioned in demographics, is even though the U.S. has a lot more old people than it did before, it also still has a fairly young, healthy population when you compare it to, say, Germany, Italy, or Japan. And even 10 years from now, the worry that you have with China is that China may get older faster than it gets rich. So if there's something to watch the population pyramids in the US versus the population pyramid of China.
Right, and then also, do you think at this point, does the US economy need any sort of stimulus? And if the answer is no, like when, how bad does it have to get in order for it to really need some stimulus from the central bank?
Well, the problem with stimulus is that it's basically pumping money in, and in some cases incenting people to take risk, even if it's not necessarily smart risk. So really, what we're talking about here, when we're talking about small 25 basis point adjustments, you could argue, is it really stimulus, or is it just a minor adjustment to make sure you're not choking off some of the more sensitive parts? If you look at financials, or if you look at, again, those very capital-intensive industries, 25 basis points makes a difference. If you look at technology, if you look at the areas where we've had innovation, businesses that have 10% return on asset rates, 25 basis points does not make a difference.
Right, and then in terms of the Fed, obviously in the course of fighting a U.S.-China trade war, many view that U.S. President Donald Trump, he's been using the Fed as one of the economic tools in terms of bailing him out whenever he tries to escalate the U.S.-China trade war, right? So what exactly, in your view, does President Trump want from the Fed, since he's repeatedly expressed that he's not happy with the Fed's action, and can Fed really bail him out in any sense?
Well, the good thing, I guess you could say, about Donald Trump is he's been very open about his views on Twitter. He's, directly criticized the Fed in a way that's quite unprecedented, saying the Fed has kept the dollar too strong, they've kept interest rates too high. President Trump's view is quite clear that he wants interest rates down and he wants the dollar to weaken. Now, you've seen that in previous leaders before, I think going all the way back to Nixon, really ever since currency started floating. You've seen presidents maybe saying certain things or wishing the Fed would do certain things. One thing I think we can agree the Federal Reserve is united on is they both want to maintain central bank independence and central bank credibility. And so far, that's been the case. That's one reason why we're only seeing 25 basis point cuts, and we're seeing them very thoroughly explained, rather than any central bank governor saying, the president wants this, he lets roll over.
Mm-hmm. And then in terms of the U.S. central bank's action, does it really have the power to, offset, any trade policy uncertainties that President Trump might have hoped?
Not really, because trade policy uncertainties are directed at different things. If you're an American technology company and you're trying to decide whether to manufacture your new invention in China or Vietnam or so on like that, Fed policy is not going to direct that. Fed policy is not going to tell you where to make your investment decisions. Tariffs and trade deals, that's going to have a lot more impact on that. If on the other hand, you're trying to decide whether to invest in a building that has a cap rate of 4%, 25 basis points will have an impact on how much money you take home. So it's more that it will affect different parts of the economy in different ways. Now, the other side of the political spectrum, we were talking about Trump and what he would like. The American left has also been pointing to the fact that there's been growing wealth inequality. And one of the big drivers of growing wealth inequality has been low interest rates that have pushed up asset prices. The big worry you have to worry about easing of Fed policy is that's only going to make that much wider. It's going to make that problem that much more extreme. Mm-hmm. So whether Trump wants that or whether the left wants that is something you watch on the political side. On the economic side, what I'm watching for is the dollar is strong. If rates start coming down, that might be a cyclical end to the dollar strength, and that would be good for emerging markets and other assets as well.
Right. Another major development that we saw between Beijing and Washington is that the U.S. recently called China a currency manipulator. Yep. After yuan broke 7. So in terms of this major development, how do you view this will play into the future price movement in terms of the yuan? Can it officially enter a free fall now?
Well, we were talking earlier about the Fed and Trump saying that the dollar was too strong, and one of the pairs you look at the dollar being strong against is the renminbi. That 7 level was very, very critical. I mean, a lot of traders were watching it. A lot of it were saying that oh, the PBOC doesn't want to let it break, and now it's broken. Now it's 2% off even that 7 level. Now, if you ask me, a 2-3% move is not exactly what you call a currency manipulation. That said, Trump wanted to use the currency manipulator label so that he could take other measures that you can do when you've applied the label of currency manipulator. I don't think we have to worry about the renminbi going into free fall. One thing that China has at its disposal, it has enormous dollar reserves and foreign currency reserves that no other country can really amount to. And it has a real economy backing it up. What we're really looking at here, just like we talked about 25 basis point adjustments in the federal funds rate, the adjustment in the Chinese currency is in effect an adjustment for the Chinese economy as well. Several Asian economies use their currency as a monetary policy tool, and for the PBOC, that's just one that China has.